Okay, welcome everyone. We're going to work Chapter 3, the comprehensive problem. And the way I'm going to approach this with you is by using an Excel spreadsheet. They don't require that in the textbook, but they actually are asking you to present the entries that you would make in order to accomplish a consolidation. And we're going to actually go ahead and present it in a worksheet format because that's what's going to be required going forward in chapters 4 and 5. You will want to get comfortable with using Excel and the spreadsheet. Now before you even get going, I know you're staring at a spreadsheet right now in this video. What I want you to do is print out, there's a PDF file that has the problem copied out of the textbook, and I'd put it on one page so you can just print it out and have it in front of you. Read it a couple of times before you actually get into the mechanics of the problem and what we're going to do on these spreadsheets. So if you need to, go ahead and pause this recording, this video, and get out the that PDF and read through the problem, read it a couple times, and get familiar with what we're trying to do. And the first thing you're going to see that's a little bit different than what you're asked to have on the solution is I presented this in a trial balance format. Now I don't want you to freak out on me because I've got a plug number here to get my trial balance to balance. So what I'm doing is dropping all of these numbers. This is actually a blank template that you're going to fill out along with me. And don't worry, I've got the completed right here and everything works out just fine. But these numbers here for both the parent company, which is called top, the subsidiary company, which is called bottom, I've dropped in these numbers off the problem, and then what I've had to do in order to get total assets and total liabilities and equity to agree is plug a number. The reason I'm having to do that is the authors, because they didn't present this in a spreadsheet or a trial balance format, they said they're giving these amounts for selected accounts. So you'll see that wording in the problem itself, and again, that's why I'm having to put this plug number. And just so you know, it works out because at the end on the consolidated column, which is what we have on the right hand side, I use the same number. So, and trust me, everything does balance out, so we're good to go. Now, the first thing you're going to want to do, okay, we're going to have two videos on chapter 3. The first one is covering what happens when the parent company has applied the full equity method for the ongoing period of time. In this case, we're dealing with 3 years, 2011, 2012, and 2013, and how does that look in a consolidation and what's required. And then the second video that I'm going to cover with you is what happens when you have the initial value method. So you have choices of either doing a full equity or just the initial value, and there's of course a partial equity. And I'll be honest with you, from a practitioner standpoint, I really don't see the value in using the full equity method. It's more complex, more cumbersome. And frankly, in practice, what you'll see is most people using the initial value, and then they'll keep a roll forward as if they were using the equity method. They'll keep not a subsidiary ledger, that's the wrong word, but a file, if you will, where they've got all the records of dividends and the earnings of the subsidiary. And the book makes the argument about, well, you need to use the full equity method in order to track the performance of the subsidiary. And the fact is, you're going to have all kinds of metrics on tracking their performance, and you're not really going to use the equity accounting to gauge whether that subsidiary is doing what it's supposed to do or not. So regardless, we're going to go ahead and cover it. It's a great way to go back and review your learning from Chapter 2. When we had to get down and dirty with, or excuse me, chapter 1, I guess, is when we had to get down and dirty with the equity method, and then chapter 2 is a basic consolidation snapshot in time at the point you buy the subsidiary, and chapter 3 we're getting into a little more complication in that we're moving forward, as you can see. So the first thing to do is to roll forward this balance that we have. Now, all this data is given to you straight in the problem. You'd have it, of course, in real life in your financial records. And they say they earned $100,000 of net income. There was a dividend paid of $30,000. We'll put that in there as a negative. and there was amortization of $9,000. Now, let's first then say, where did we get this amortization? Well, if you go back and look at the problem, you'll see that there was an excess of they paid $842,000, okay, which we have that number right there. And if you want to then allocate that to the various undervalued assets, we had a building at $72,000, and I'll just drop these numbers in over here. This is pretty easy arithmetic. We had equipment of $10,000. And we had a license agreement that was previously not recognized, but now we want to recognize it because we can with the consolidation. So you have all those numbers there. I was going to do some quick formatting. Here we go. And then the useful lives, we had 20 years here on the agreement. We had the building was 10 years. And then we had a 12-year life on the building. Excuse me, equipment was 10 years, building is 12. So then simply, if we just take these numbers, divide them by their useful life, you're going to get the per year amortization that we need to record. So there's the $9,000 that we're looking for. Really struggling. Sorry about that, guys. There we go. So then we need to keep moving forward on this roll forward. 2012, we had net income of $120,000. We had dividends that were paid by the subsidiary were $20,000. Put then there as a negative. And then, of course, then our amortization comes forward one more time. While I'm at it, I'm going to go ahead and do an auto sum feature so we can then snapshot this balance. I'll copy that forward, or copy that formula down, and drop in our 2013 numbers to complete this cycle. We had dividends then of negative $10,000, and then the amortization again is $9,000. Okay, so we end up with the $1,095,000. Started out at 842. 842, where do we get that number? In the acquisition method, you're using what is the most determinable or readily available, obvious amount, and so you can't get any better when they say, you know, you're either issuing stock or paying cash. In this case, it's cash, so that's fairly objective, as we have the cash number there. And then we, completed this roll forward. Now I'm going to give you, there's the solution, if you will. Now what I would like you to do too in this is pay attention to the fact each year we're going to use these in our entries, but I've grouped together. You can see the for 2011 where you've got a sum of $61,000. 2012, the net sum is $91,000. But I combined all these things for 2011 and 2012 to show you then what the aggregate difference is. In 2013, then also I'm netting the income and amortization at $111,000. You'll see that. So I just wanted to show you the source of some of these numbers that we're going to have in the entries. So again, this is in your solutions as a roll forward. But I wanted to go through the actual roll forward that you're going to need to do both in the problem for your homework and as well as in practice. Okay, so we need to fill in this blank template now. And again, I've got this all completed, and I've already mentioned to you that when I laid all these balances out, for their debits and credits and everything else, to see if my total assets equal total liabilities and equity, they don't, because I had to plug this number. And the reason again is because the authors just didn't give you all of the data. So maybe there's some additional liabilities or whatever, but it doesn't matter for the purposes of the illustration. The other thing I'm showing out here is in your textbook. You need to highlight this from your book. It starts on page 92. in chapter 3, and it's a mnemonic, and hopefully all of you are going to end up taking the CPA exam, and many of you may use Becker's Review, which is probably one of the most prominent review courses. It's been around for years, decades actually, and they're big on mnemonics. But in this case, you kind of have one, said with an E at the end of it. I know that's not the correct spelling, but each of these letters stands for one of the entries that you're really going to need to make on these eliminations and adjustments in order to get to this consolidated total. And again, the consolidated total is what you're going to present on your 10K or 10Q to the outside investment community. They're not going to see all of this stuff, and these debits and credits, to repeat, you're not going to book these onto your general ledger. You'll have this either in Excel or Hyperion or whatever your software is that you use to accomplish this stuff. And the cool thing about that is you then have a breadcrumb trail, or a record of what you did each quarter. And so it becomes very easy, to do these roll forwards and stuff, because you can see how it built up over time. Okay. Now, so the first thing to do is if we go take a look at what we have sitting in our investment account, there's your $1,095,000. Okay, and remember, this is December 31st of 2013. So we've rolled that forward, and we know that balance is $1,095,000. But from an entry standpoint, and if we take the first entry, the stockholders' equity eliminations, what do we have to do in that regard? Well, the first thing is we had $400,000 that we're going to take out of the investment, okay? Because when we bought this company, what happened is we paid cash, so we're crediting cash. What are we debiting? Well, we're debiting the investment account, this asset. And then we were purchasing the common stock, basically the equity, the net assets. Again, the equity is assets minus liabilities. So what common stock did they have in this company? Well, there's $400,000 of Bottom's common stock. So what we need to do then to offset this $400,000 is we're going to have a debit, and you see my cross-reference, this S is my cross-reference, because as you know, as good accountants, the debits have to equal credits, so I better get another 0 in there. Okay, so that takes care of the $400,000. Now, what else did we do? We had the equities made up of both common stock and retained earnings. So I need to, the beginning retained earnings that I purchased in Bottom was $320,000. Count my zeros there, we're good. And so then I'll have that 320 is going to go against the investment account. Okay. Now, the other thing, I think at this point I'm good to go. Well, we've got one more thing to deal with, and I probably have mislabeled this. I had a $50,000 transaction, which was actually my dividends that I have paid. And let's go back and see that on this roll forward that you have. This $50,000 here, you had a dividend of $30,000, a dividend of $20,000. That's your combined amount of $50,000. Now you have to think then, what do we do in accounting when you're paying a dividend? Well, in this case, under a full equity method, what did Top Company, which is our parent here that had this investment in the subsidiary, what did they do with that $50,000? Well, the fact is, when they got the money, they credited the investment. So what we need to do is bring that back in, 50,000, there we go. And what happened on the subsidiary that's paying this dividend, they had actually reduced their retained earnings. So what we're going to do is bring that back, okay, to reset the clock, if you will. And because what is our end game goal here? This number in this cell, I'll go ahead and put the formula in. That has to be the ending number that we've rolled forward, that $1,095,000. and then we're going to add the debits. So I'll just go ahead and bring that down there, the formula. We're going to add the debits. Let me grab another parentheses. And then subtract the credits that we're making, which will be the sum of our credits. Okay, so I'm getting there. I'm gaining on it. So I've taken away about $600,000-700,000, and I've got to eliminate the rest of that, and we'll get to that in just a minute. Now, the other thing that's happened over time, over these 3 years, is we've had income that has been earned by Bottom. And remember, under full equity method, when a subsidiary or an investee is earning income, what happens on the parent's books? Well, the parent is debiting the investment account for those earnings that have happened. Now, let's go back and look. You have this in your on Blackboard as your template. Or excuse me, it's actually one of your solutions. And you'll notice that in 2011 and 2012, they had earned, Bottom had earned $220,000 of income. And so what did Top do? Top had recorded that in their investment account. So this $220,000 now needs to come out of the investment account as a credit. And you can see that we're gaining on trying to get this investment eliminated. And so where does the debit go on that 220,000? Well, again, it's been recorded in retained earnings. So what Top did as they got that recognized their share of the income of the subsidiary, they're debiting the investment, crediting the equity earnings in subsidiary. That is a temporary account. It gets closed out to retained earnings. So that's why we're going to debit the $220,000 to retained earnings. Okay. Now at this point, we have taken care of stockholders' equity eliminations. So we're done with that. I'll maybe change the highlighting on it a little bit. And what do we have to do now? Now we have to focus on allocations of fair value, because the fair value allocations were part of the $842,000 balance in our beginning investment account. And what were those allocations that we had? Now, to attain the amount for that journal entry that I need to make, or that entry on my consolidation worksheet, you can see the importance of maintaining lots of little records. Okay, that's why you have software to do this. Now I've gone ahead and added some labels here. The building equipment and license agreement. Remember, these are the things that exceeded the book value that they were on Bottom's book when we bought this investment for cash. The building equipment license agreement were not, they were either undervalued or not on the books. So what I've done here, remember I had the useful lives to figure out what 1 year's amortization. Now what I'm going to do is, because I'm now having to catch this thing up, I've gone forward 2 years, 2011 and 2012. So what would 2 years amortization be? So I'll just take each year's amortization, multiply it by 2. Bring that formula down, and then I'll then do a quick calculation of what the net book value is down below here, and make sure that's what I had. Yeah, the building was 60, the license was 36, and that's what I did up here. Now, those are my debits, so I add them together, and I can see down here that my total is $104,000. And where does that go? What's the credit side on this elimination entry? Well, it's to the investment account, obviously, because that is where that amount, excuse me, 104,000. That's where that amount was as a result of my purchase of Bottom. Now you can see I'm really close at this point. I'm at $51,000. Not there yet, but you can see I've got a couple more entries I need to make. And so, what are those entries? Well, okay, so now we've handled the allocations of fair value. Now this letter I, which is the income removal, what we're doing with that is we had the equity and subsidiary earnings. This is the current year. Again, Top is using a full equity method of accounting for Bottom, and so this income statement is only for 1 year, so it's for the 2013 year. And what's happened with that? Well, what actually happened is I had to 120,000 of that is my equity earnings. I own 100% of Bottom, and what did Bottom earn? If I look down here, they earned $120,000 of income. So on Top's books, that 120,000 is within this this revenue number, if you will. That's what equity and subsidiary earnings is. It's an income statement account. It normally has a credit balance. So what do I need to do to eliminate that? Is I've got to debit it for 120 grand. Okay, and what am I doing? I'm eliminating the 2013 income from Bottom that I, as Top, recognized on my books as equity and subsidiary earnings. Okay, so there's the 120,000 debit against this. What am I showing? 111,000. Well, the difference, if I again go down and look at my roll forward, the difference is this excess amortization expense of $9,000. That's where that calculation came from. And go back to your learning on Chapter 1, Equity Method. When you're applying that, you have that amortization of that excess value for your assets. It goes against the equity and subsidiary earnings. So I'm going to restate that. Okay, put it right there. So the net of these two numbers, my debits and credits, is $111,000. $120,000 minus $9,000. So what I'm going to do is that $111,000 will go against the investment account. I apologize. I realize I had a formula error over here in my consolidations column. So what I'm going to do is go back and I'm just going to kind of reset that. So again, we're taking this cell, the investment that we rolled forward, and then we're going to add any of these adjustment debits we're going to make. So I'll be careful on my typing here. And so I'll add the debits, and I will subtract the credits. So all of this column. So at this point, still didn't like my formula, but let's see what we have. Okay, yeah. So now at this point, we just made the allocation of $111,000 on our income, and that was, remember, that was the net of these two numbers, the 120 debit and the $9,000 credit on this to eliminate this equity and subsidiary earnings, because that's going to now be zero, and you'll see where all of these columns, whatever's in my top plus bottom, and then add my debits and subtract my credits to get a final total. Now, so we've got one more thing to do, and so we just handled the removal of the income. That's good. Now the dividend eliminations, the letter D. So what do we do there? Well, going back to your learning on the equity method, a dividend paid by the subsidiary to the parent will record that, and they're going to record that as a reduction of their investment account. They're debiting cash, crediting the investment in the subsidiary when they receive the dividends. So what we need to do is bring back that $10,000 entry. And the cool thing is now you see that I have successfully eliminated the investment in Bottom Company, but where's the offset to this $10,000? Well, if you go up then to your statement of retained earnings, there's your $10,000 dividends paid in the current year, which is a debit. So I'm going to need to credit $10,000 on that, and of course you're going to see then the ending result. If this is the way this formula would work, is I'll take what number I have for top, add the number for bottom, and then if I'm talking about dividends, I would be adding a debit, and then because the credits reduce dividends, I will reduce credits and end up, I'm just having a lot of difficulty with my formula, but I'll end up with $70,000. You can see how we crossfit that. And again, don't worry about these. I've got all the formula worked out in your completed template that I really want you. I'll hold off on giving you that until we have the homework assignment ready to go. Okay, at this point, I just misspoke there actually, because I know this is not homework, so you're going to have that provided to you, because I do want you to see how all these numbers crossfoot and everything else. So I apologize for that. All right, so we've now eliminated, taken care of our dividends. Now, what about this excess amortization expense? Well, we already know what those numbers are. It's $9,000 for 2013. That's my number right there. So what do I have to do? I'm presenting my assets at a net book value. And so the amortizations are going to then be a credit for the 2013 expense, depreciation or amortization expense. I need to record that on my consolidation worksheet. So I'm just taking those numbers from what we did earlier: $2,000 on the license, $1,000 on the equipment, and then $6,000 a year. So again, I'm only dealing with 2013, so that's going to reduce my net book values, and so this is my, I labeled it E1 just to keep track of it a little bit better. So okay, so what is the offset to that? Well, again, I'm trying to record for 2013 what will I present to the outside world as my on my income statement, and that's where I'll have the debit of $2,000 related to that the license agreement, because it's an intangible, and I'll have $7,000, which is a sum of $6,000 on the building and $1,000 on the equipment. So that's what I have to then add as a debit in my consolidation adjustment to then get to my end number. Okay, which again, this is going to be obviously $2,000 because I had nothing to start with. And then on these formulae, I will take my both of my entities, add them together, add my debits, and there's no credit to subtract, so I won't bother you with that formula, and I'll end up with $167,000. Okay, now we might as well go ahead and do our COGS, which is just going to be the sum of these two. I'll do that very quickly here. And revenue obviously will be the sum of the parent and the subsidiary. Okay, so at this point, net income for the year is $411,000. If I look at my dividends paid, and for some reason I am not. Oh, here we go. Here we go. Dividends paid was $70,000. I was looking too high there. And then I get to ending retained earnings, which I haven't. Let me get my beginning balance going here. And then what I'm going to do is I'm going to eliminate, so I'm talking retained earnings, so I'm going to subtract my debits, add my credit, and I'll get to a beginning retained earnings number of $1,360,000. Okay, so if I am on my retained earnings roll forward, which would be my statement of retained earnings, beginning balance plus the income from above. Okay, so I'm just dropping these numbers down. The dividends paid of $70,000, ending retained earnings is $1,701,000. Now, in your worksheet, okay, these numbers, the way the mechanics of the worksheet are, is you're going to take the $1,701,000 and you're just flat out going to drop it down there. You're not going to worry about doing the cross-footing because you've already done all your eliminations and adjustments up here. So that's a key point, okay, when you build your template and do these, because I'm going to have you do an Excel problem for one of your homeworks for points, and I want to see that that's how you're structuring it. So all you have to do is model off of this one. Okay, now let's go ahead and knock out a few of our balance sheet accounts that are real simple. Again, just adding across. Do the same thing for inventory. Now, there's nothing to mention on intercompany receivables and payables, but let me tell you this from practice. That usually is a big number. Usually there's a lot of, and we're going to get into it with intra-entity, or inter-entity, excuse me, transactions. In practice, what you will see if you ever become a controller, a good policy to have is you never allow anybody, any of your other affiliated companies, subsidiary companies, because each one will have an intercompany payable or receivable with any other entity in the family. And the rule is, the policy is nobody ever makes a debit or credit to intercompanies without notification of the reciprocal party. So the the smart thing about that is you never get out of balance, because in your consolidation you have to eliminate intercompany receivables and payables together, and those should all net to zero. And if they don't, you don't go home that night until you figure out why. So obviously the way to do that, to keep yourself from having a lot of grief when you close your books, is don't ever let them get out of balance. So whatever the entry is, there has to be that reciprocal on the other entity's books. So that's a word to the wise as we go forward. All right, to wrap this up, for full equity method of accounting for the investment in the subsidiary and the consolidation entries that you need to make, I've gone through and I've put in the formulae for the rest of the liabilities and other accounts. And now the cool thing is, this is where you maybe a little cause for celebration, is once you've done all this, you know, the debits and credits equal on my consolidation eliminations and adjustments. That's a great thing. And then I can see that my balance sheet balances. That's also another great thing. Total assets equals total liabilities plus equity. So, you know, because I've got those things are true, I probably have about a 98 or 99% confidence level that I have a correct consolidations. Of course, the risk is maybe you forgot to do an adjustment or an elimination, and that's why you have people reviewing this as part of your Sarbanes-Oxley controls, and also you have you know, a kind of a legacy, and so basically almost a procedure of steps you go through to get this done, because the level of complication, as you can imagine, is pretty intense. But anyhow, so congratulate yourself. You've now done your first full-blown consolidation with you know, a multi-year approach. And what we're going to do on the next video is talk about the initial value method, which frankly is the right way to go. That's what you see in practice, as opposed to doing a full equity. And in essence, you still have to do kind of a roll forward of that investment balance either way. But I think you're going to see, if you juxtapose this video against the one we'll do on the initial value, you're going to ask yourself, why would anybody go to the trouble of doing full equity on their books? Because remember, these are the general ledger balances. These two columns here are the general ledger balances of these two companies, and so by definition they've been making journal entries to get to that $1,095,000 investment balance. So thanks for your attention on this. Go back and work it. Make sure you know where these numbers, how they were derived, and what we did on the mechanics of the worksheet. Okay, talk to you soon.